The dollar isn't collapsing. Dollar exchange rates remain relatively stable. American Treasury securities still attract global investment. The dollar remains the world's primary reserve currency, with approximately 59% of global foreign exchange reserves. American financial markets remain the deepest and most liquid globally. By conventional metrics of currency strength, the dollar looks fine. But something fundamental is changing that conventional metrics don't capture. The dollar isn't collapsing, it's being bypassed. Countries aren't abandoning the dollar because it's weak. They're building alternative systems because dollar dependence creates vulnerabilities they've decided are unacceptable. China and Russia conduct energy trade in yuan and rubles. India purchases Russian oil in rupees. Brazil and China settle trade in their own currencies. ASEAN nations develop local currency settlement mechanisms. The BRICS grouping, now expanded to include Saudi Arabia, UAE, Iran, Egypt, and Ethiopia, discusses creating alternative payment systems and potentially common currency. These aren't countries fleeing a failing dollar. These are countries building insurance against dollar weaponization after watching how dollar-based sanctions have been deployed against Russia, Iran, Venezuela, and others. The dollar remains powerful, but is becoming optional rather than mandatory for growing portions of global trade. This is more dangerous for American power than dollar collapse would be. Collapse would be crisis requiring emergency response. Bypass is gradual erosion that accumulates until suddenly the dollar's centrality to global commerce is gone, and American financial leverage with it. Understanding dollar bypass requires examining the specific mechanisms countries are building, why these alternatives are now viable when they weren't previously, and what happens as dollar's mandatory role diminishes. The BRICS expansion and alternative payment systems represent the most visible challenge to dollar dominance. BRICS originally consisted of Brazil, Russia, India, China, and South Africa, emerging economies collectively representing substantial global GDP but limited coordination. The 2023 expansion to include Saudi Arabia, UAE, Iran, Egypt, and Ethiopia transformed BRICS from discussion forum to potential dollar alternative. Saudi Arabia and UAE bring energy exports that have been exclusively dollar-denominated for 50 years. Their participation in BRICS signals willingness to consider alternatives to petrodollar system. Iran brings experience operating outside dollar systems through decades of sanctions evasion. Egypt and Ethiopia add African participation to what becomes genuinely global South coalition. The Saudi Arabia dimension deserves particular emphasis because Saudi decision to join BRICS represents potential breaking point for petrodollar system. The petrodollar was established through 1973-1974 agreements, where Saudi Arabia and other OPEC members agreed to price oil exclusively in dollars and invest oil revenues in U.S. Treasury securities. In exchange, the United States provided security guarantees, weapons sales, and political support. The arrangement lasted 50 years with minimal deviation. Saudi oil was dollar-denominated. Saudi Central Bank held hundreds of billions in dollar reserves and treasuries. Saudi willingness to explore alternatives reflects fundamental shift. China is now Saudi Arabia's largest oil customer, purchasing approximately 25% of Saudi exports, worth over $50 billion annually. Saudi Arabia discussed accepting yuan for Chinese oil purchases in 2022. The discussions didn't immediately produce results, but the fact that Saudi Arabia entertained the possibility was significant. For 50 years, suggesting Saudi Arabia might accept non-dollar payment would have been dismissed as fantasy. Now, it's active negotiation. The strategic calculation is that Saudi security dependence on the United States is diminishing. American shale production made the United States energy independent, reducing American strategic interest in Saudi stability. American foreign policy priorities shifted to Indo-Pacific competition with China, rather than Middle East stability. The Biden administration's human rights criticism of Saudi Arabia following Khashoggi murder strained relations. From Saudi perspective, if American security guarantees are uncertain, the petrodollar bargain's value decreases. Chinese economic ties combined with potential Chinese security cooperation might be more reliable than 50-year-old American arrangements. The BRICS currency discussions are preliminary but significant. Proposals range from creating entirely new common currency to establishing clearing mechanisms using members' existing currencies. The technical challenges are enormous. Creating currency union requires monetary policy coordination that's politically difficult, even among more integrated economies like the Eurozone. But even short of common currency, BRICS payment systems that allow direct settlement between member currencies without dollar intermediation would reduce dollar's role in approximately 40% of global population's commerce. The China-Russia energy trade demonstrates how bilateral arrangements chip away at dollar necessity. Russia exports oil and natural gas to China worth over $100 billion annually. Before Ukraine sanctions, these transactions were dollar-denominated and settled through SWIFT and Western banks. Sanctions made this impossible. Russia and China shifted to yuan and ruble settlement using Chinese and Russian banks. The mechanism is straightforward. Russian exporters receive yuan payments in Chinese banks. Chinese importers pay in yuan that Russia uses for purchases from China or converts to rubles. No dollars are involved. No SWIFT messaging is required. No Western bank processes the transaction. The volume is substantial. Russia is now China's largest oil supplier at approximately 2 million barrels, daily worth roughly $150 million daily, or $55 billion annually at current prices. Natural gas adds billions more. Russia cannot easily spend all the yuan it earns. Russian imports from China totaled approximately $110 billion in 2023, less than Russian exports. The surplus yuan accumulates in Chinese banks or gets invested in Chinese securities. This creates dependency on yuan-denominated assets. But from Russian perspective, yuan dependency is preferable to dollar dependency that comes with sanctions vulnerability. The broader lesson is that any two countries with substantial bilateral trade can establish direct currency settlement given political will. The technical requirements are minimal: correspondent banking relationships, exchange rate agreements, and payment clearing mechanisms. These existed during Cold War between Soviet bloc and Western countries for trade that couldn't use dollars. The infrastructure for non-dollar trade exists. What's changed is political willingness to build and use it. The swap agreements between central banks represent quieter but potentially more significant development. Currency swap lines allow central banks to exchange their currencies without going through foreign exchange markets. If Chinese yuan and Brazilian real have swap line, Brazilian central bank can obtain yuan directly from Chinese central bank by depositing reals. This provides liquidity for yuan transactions in Brazil without requiring Brazil to hold large yuan reserves or purchase yuan in foreign exchange markets using dollars as intermediary. China has established swap lines with over 40 countries totaling over $500 billion in swap capacity. The swap lines aren't all active simultaneously, but their existence provides infrastructure for yuan-denominated trade without dollar intermediation. Brazil can import Chinese goods paying in reals that Chinese central bank accepts through swap line. China can export to Brazil receiving yuan that Brazilian central bank provides through swap line. The transaction doesn't touch dollars or dollar-based payment systems. The swap line network creates alternative liquidity provision that historically was dollar's unique advantage. Countries held dollar reserves because international trade required dollars for transactions. If transactions can occur in national currencies through swap lines, the need for dollar reserves diminishes. This doesn't eliminate dollar overnight, but each swap line and each bilateral trade agreement reduces dollar necessity incrementally. The India-Russia rupee-ruble trade illustrates both the opportunities and complications of non-dollar settlement. India imports Russian oil worth over $50 billion annually. Western sanctions on Russia made dollar payments problematic. India and Russia agreed to rupee-ruble settlement, where Indian refiners pay rupees into Indian bank accounts that Russia can use for purchases from India. The mechanism works in principle. The complication is that Russia doesn't import enough from India to balance the trade. Russian rupee accounts accumulate billions that Russia cannot easily spend or convert without going through foreign exchange markets that might enforce sanctions. The surplus currency problem afflicts most bilateral arrangements. Trade is rarely balanced between any two countries. One accumulates the other's currency in amounts exceeding what they can spend directly. The dollar solved this through global liquidity. Any country could convert dollar surplus into purchases from any other dollar-accepting country, which was essentially everywhere. Bilateral currency arrangements lack this liquidity. Russian rupees can only buy Indian goods unless Russia can find third-party willing to accept rupees, which is difficult because India itself prefers dollars or yuan for imports from third countries. The solution emerging is triangular arrangements, where 3 or more countries create currency clearing circles. Russia accumulates rupees from oil sales to India. India imports machinery from China, paying yuan. China imports Russian commodities, paying rubles. The currencies circulate without ever touching dollars. The complexity is arranging timing and amounts so that currency flows roughly balance. This requires substantial coordination, but is feasible among countries motivated to reduce dollar dependence. The commodity pricing shift from dollar-denominated to alternative currencies is strategically significant beyond immediate transactions. Oil is traditionally priced in dollars globally. Buyers from any country purchasing oil from any supplier quote prices in dollars per barrel. This creates structural demand for dollars because any country importing oil needs dollars to pay, regardless of where the oil comes from or where the buyer is located. The petrodollar system established in the 1970s made this explicit. OPEC members agreed to price oil exclusively in dollars in exchange for American security guarantees and weapons sales. The system is eroding gradually. Russia now prices oil exports to China and India in yuan and rupees, respectively. Iranian oil exports are yuan-denominated. Venezuela accepts yuan for oil. Saudi Arabia has discussed accepting yuan for Chinese oil purchases. UAE is establishing yuan clearing systems. Each shift away from dollar pricing reduces structural dollar demand. If China can purchase oil in yuan, Chinese importers don't need to hold dollar reserves for energy purchases. This reduces Chinese dollar demand by tens of billions annually. The shift extends beyond oil. China is establishing yuan pricing for other commodities through Shanghai futures exchanges. The Shanghai International Energy Exchange launched yuan-denominated crude oil futures in 2018. Trading volume grew to over 200,000 contracts daily, not yet approaching Brent or WTI benchmarks, but establishing yuan as viable oil pricing currency. Shanghai Futures Exchange trades copper, aluminum, and other metals in yuan. The liquidity is building gradually. As yuan commodity markets deepen, more international trade can price and settle in yuan without dollar intermediation. The specific mechanics of Shanghai crude oil futures reveal how alternatives gain traction. The INE crude oil contract is denominated in yuan per barrel, but convertible to gold at Shanghai Gold Exchange. This petro-yuan mechanism addresses the convertibility problem that limits other currency alternatives. A Middle Eastern oil producer selling to Chinese buyers can accept yuan knowing the yuan is convertible to gold if direct yuan spending opportunities are limited. The gold convertibility provides liquidity escape valve that pure bilateral currency arrangements lack. Trading volume on Shanghai crude futures reached 1.5 million barrels daily equivalent by 2023, approximately 1.5% of global oil consumption. This seems small but represents remarkable growth from zero in 2018. For comparison, Brent crude futures took decades to reach current dominance. ICE Brent trades approximately 600 million barrels daily equivalent, 400x Shanghai volume, but Brent's growth trajectory was similar, slow accumulation of liquidity over decades until critical mass made it primary global benchmark. Shanghai crude is following the same path, but compressed into faster timeline because technology, market infrastructure, and political motivation enable faster adoption. The critical mass question is how much non-dollar trade needs to exist before alternatives become self-sustaining. Dollar dominance created network effects. Everyone used dollars because everyone used dollars. Accepting dollars was easy because spending dollars was easy because everyone accepted dollars. The circular logic sustained dollar centrality even when alternatives might have been equally efficient technically. Breaking network effects requires reaching threshold where enough participants use alternatives that using alternatives becomes self-reinforcing, rather than requiring constant political will to overcome convenience of dollar systems. The threshold is probably 25 to 30% of global trade. Below that level, dollar alternatives remain niche arrangements requiring extra effort. Above that level, alternatives have enough liquidity and acceptance that using them becomes routine rather than exceptional. Current estimates suggest 10 to 15% of global trade now occurs in alternative currencies or barter arrangements outside dollar systems. The growth rate is 2 to 3 percentage points annually. At current trajectory, the threshold could be reached within 5 to 7 years, after which dollar bypass accelerates as network effects shift from supporting dollar dominance to supporting multipolar currency system. The SWIFT alternative payment systems demonstrate the infrastructure bypass that parallels currency bypass. SWIFT is the Society for Worldwide Interbank Financial Telecommunication, a messaging system that banks use to communicate about transactions. SWIFT itself doesn't move money, but it provides standardized messaging that makes international payments efficient and verifiable. Western governments can pressure SWIFT to exclude banks from sanctioned countries, which makes those banks unable to process international payments through normal channels. Russian banks were expelled from SWIFT after Ukraine invasion. Iranian banks were excluded earlier. The exclusion makes dollar transactions impossible, but also drives development of alternative messaging systems. China's Cross-Border Interbank Payment System, CIPS, provides alternative to SWIFT for yuan transactions. CIPS launched in 2015 and now processes over $50 billion daily in yuan cross-border payments. It's not yet approaching SWIFT's $5 trillion daily volume, but growth is rapid. Any bank anywhere can connect to CIPS to send or receive yuan payments without touching SWIFT or dollar correspondent banks. Russia, Iran, and other sanctioned countries use CIPS for trade with China. The more countries connect to CIPS, the more useful it becomes as SWIFT alternative. The infrastructure comparison shows both the gap and the trajectory. SWIFT connects over 11,000 financial institutions in 200-plus countries. Messages sent through SWIFT number approximately 45 million daily, covering over $5 trillion in transaction value. The network effects are enormous. SWIFT is valuable because everyone uses it, and everyone uses it because it's valuable. CIPS connects approximately 1,400 financial institutions in 100-plus countries. Messages number approximately 80,000 daily, covering $50 billion, roughly 1% of SWIFT's scale. But the growth rate matters more than current scale. CIPS processed $12 trillion in annual cross-border yuan payments in 2023, up from $2 trillion in 2020. The 500% growth in 3 years demonstrates adoption acceleration. At this trajectory, CIPS could reach $50–75 trillion annually by 2030, still smaller than SWIFT, but large enough that excluding banks from SWIFT no longer means excluding them from global payments. The parallel infrastructure provides insurance against sanctions that was previously unavailable. Russia developed its own SPFS, System for Transfer of Financial Messages, as SWIFT alternative. It connects over 400 Russian banks and some foreign banks from countries willing to maintain Russian payment relationships. The volume is much smaller than SWIFT, but provides insurance that Russian financial system won't be completely isolated from international payments. The psychological effect is more important than current usage. Knowing alternatives exist makes SWIFT exclusion less threatening and reduces leverage that SWIFT exclusion provides. The cryptocurrency and blockchain dimension offers potential for completely decentralized alternatives that no government can control or exclude. Bitcoin and other cryptocurrencies can theoretically allow international payments without banks, SWIFT, or any central authority. The practical limitations are significant. Cryptocurrency volatility makes it unsuitable for commercial transactions, requiring price stability. Transaction processing limits prevent large-scale commerce, and regulatory uncertainties create legal risks. But central bank digital currencies, CBDCs, could combine cryptocurrency technology with central bank backing to create digital payment systems that bypass existing financial infrastructure. China's digital yuan is furthest advanced among major economy CBDCs. It's designed to allow instant settlement of domestic and potentially international transactions without requiring commercial banks as intermediaries. If China and other countries establish interoperability between their CBDCs, international payments could occur entirely outside dollar-based banking systems. The technology is ready. The political coordination is developing. The timeline is probably 5 to 10 years before CBDC-based international payments become routine, but the direction is clear. The American response has been largely rhetorical. American officials warn about risks of dollar losing reserve status. They emphasize dollar's advantages: deep liquid markets, rule of law protecting property rights, and American economy's size and stability. These advantages are real but don't address the fundamental driver of dollar bypass. Countries are building alternatives not because dollar is weak, but because dollar dependence creates vulnerabilities that sanctions demonstrate. The sanctions against Russia were extraordinarily comprehensive. Russian central bank reserves frozen, Russian banks expelled from SWIFT, Russian companies blocked from Western capital markets. The sanctions inflicted economic pain on Russia, but they also demonstrated to every other country that dollar-based assets and payment systems can be weaponized for political purposes. Countries with potential conflicts with the United States, China, Iran, Saudi Arabia, various Global South countries, concluded that holding substantial dollar reserves creates single point of failure, where American pressure could paralyze their economies. Building dollar alternatives became strategic necessity, regardless of dollar's fundamental strength. The irony is that dollar weaponization accelerated the very dollar decline that weaponization was supposed to prevent. Sanctions are supposed to be economic weapon that provides alternative to military force. But treating dollar as weapon requires making dollar mandatory. Countries must need dollars badly enough that dollar access denial provides leverage. As alternatives develop, dollar denial provides less leverage because denied countries can function with alternatives. The more frequently sanctions are deployed, the more urgently countries build alternatives. The weapon's effectiveness degrades through use. The trajectory is clear, even if timing is uncertain. The dollar isn't collapsing to crisis levels where everyone dumps dollars simultaneously. That scenario is unlikely because too many countries hold too many dollars and have interest in maintaining dollar value. But dollar is losing its mandatory role in global commerce as alternatives become viable. The shift from mandatory to optional is more significant than shift from strong to weak. Mandatory but weak currency still provides leverage. Countries need it despite weaknesses. Optional currency provides no leverage. Countries can switch to alternatives when using dollar becomes inconvenient or risky. The geopolitical implications are profound because American power has rested substantially on dollar dominance. The ability to sanction adversaries, to finance deficits through global demand for treasuries, to run persistent trade deficits because dollars flow back to American assets, all depend on dollar centrality. As dollar becomes optional, these privileges erode. Sanctions become less effective. Treasury demand softens, requiring higher interest rates. Trade deficits become harder to sustain. American power projection that has been financed by dollar privilege becomes more constrained by actual resource availability rather than monetary flexibility. The question is whether American power adapts to a world where dollar remains important but not uniquely necessary, or whether attempts to maintain dollar dominance through aggressive sanctions and financial pressure accelerate the bypass. The evidence suggests the latter. Each sanctions deployment drives more countries toward alternatives. Each financial pressure point creates motivation for bypass mechanisms. The dollar remains powerful but is becoming optional. And once mandatory becomes optional, the game is already lost, even if recognizing that reality takes years to fully materialize. The Treasury market dimension reveals the stakes most clearly. The United States runs persistent fiscal deficits requiring hundreds of billions in annual borrowing. The deficits are financed through Treasury securities sold to global investors. Foreign holders own approximately $7.6 trillion in treasuries, roughly 30% of total outstanding debt. China and Japan are largest foreign holders at approximately $1 trillion each, though Chinese holdings have declined from peak of $1.3 trillion. The deficit financing works because global dollar demand creates Treasury demand. Countries earn dollars through trade and investment, then need to hold dollar-denominated assets that are safe and liquid. Treasuries are the obvious choice, backed by U.S. government, traded in deepest, most liquid market globally, and providing modest interest return. The structural demand allows United States to borrow at lower interest rates than fundamentals alone would support. This is the exorbitant privilege that dollar dominance provides. As dollar becomes optional for trade, Treasury demand softens. Countries earning yuan from exports to China can hold yuan-denominated Chinese government bonds instead of converting to dollars for treasuries. Countries using CIPS for payments need smaller dollar reserve holdings. Each reduction in structural dollar demand translates to reduced Treasury demand, which means United States must offer higher interest rates to attract voluntary investors rather than benefiting from involuntary demand created by dollar trade necessity. The interest rate differential seems small, but compounds dramatically over time. If Treasury yields need to be 50 to 100 basis points higher to compensate for reduced foreign demand, annual federal interest costs increase by tens of billions. With $35 trillion debt, each percentage point increase in average interest rate costs $350 billion annually in additional debt service. These are budget implications that would force painful choices about spending priorities or tax increases. Choices currently avoided because low borrowing costs from dollar privilege make deficits sustainable. The timeline is probably 10-15 years before Treasury market stress becomes acute. Current foreign Treasury demand remains robust despite dollar bypass trends, but the trajectory is set. As more trade occurs outside dollar systems, the structural Treasury demand that has financed American deficits for decades will erode. The dollar isn't collapsing. It's being bypassed, and the bypass is more dangerous than collapse because it's slow enough that responses are delayed until the advantages are already lost.